If you click on this video, you want to know what a dividend yield is. Or maybe you know what a dividend yield is and you want to know what a good dividend yield is. On this video, that's exactly what we're going to find out. Hey guys, this is Keith Risley. This is Think Stocks. Give this video a like and hit subscribe if you haven't already. Let's get right into it. Let's go over the definition of dividend yield. You can find on Investopedia the definition: the dividend yield expressed as a percentage is a financial ratio that shows how much a company pays out in dividends each year relative to its stock price. So what does that exactly mean? Break it down real simple. Let's pretend there's a stock. It's worth $100 and it gives a dividend yield of 4%. That means it is giving you $4. Now, dividend yield can fluctuate, it can go up and down, but that doesn't mean they're going to be paying you more or less. What I mean by that, let's say you have a stock, it's at $100, its dividend yield is 4%, so it's giving you $4 a year. Let's say the stock explodes, it goes up to $200. So that's great for your capital appreciation. Doesn't necessarily mean that dividend yield is going to follow it. It's not going to stay at that 4% because 4% of 200 would be $8 a year. They may still only give you that $4 a year, which means you are only getting now 2%. Some simple maths there. All right, so you need to understand a dividend yield is only an estimate. What I mean by that is as long as the stock stays the same, then yes, you will get that dividend yield. So if we go back to that $100 example, as long as it stays $100, you'll be getting that 4%, which is $4. However, if the stock goes up, your dividend yield most likely will go down. The percentage is going down, not your payout. And if the stock goes down, then your dividend yield will go up. So why is this important? Why should it be relevant? Why should you look out for this? And what better way to learn than using a real example? You already know where we're about to go. We're going to jump on to Seeking Alpha, and we're going to look at Target, which is a great dividend stock by my opinion. I'm sure plenty of people would agree. So here's the stock, and again, we're going to be looking at the dividend yield and how the yield goes up and down. But before we even look at that, let's look at Target's low. Let's see where it was its lowest in the past 5 years. Right about here. So in the month of July 2017, Target was $51. Ever since, it's been on a really nice upward trend. It's more than doubled in the past couple of years. Now, if we go to dividends and we go to dividend yield right here, when this loads, what this is showing you is its dividend yield. This is the percentage that it is paying out compared to its stock price. Where's the high? Oh, look at that. July of 2017. That is when Target's dividend yield was 4.67%. So its yield was at its highest, but if we go back to summary really quick, that's when the stock price was at its lowest in the past 5 years. Right down there. So a big problem I see with a lot of people is they're chasing after these stocks with big dividend yields. And by big, I mean 6, 7, 8, 9, even 10%. And they think, I'm a genius. This is great. I buy into a 10% dividend yield. I get paid 10% on top of that, and the stock goes up maybe 10%. I'm making 20%. I'm going to be rich before you know it. It's not the case, and this is why. Dividend yields change. They don't stay the same. And Target's a perfect example. All right, so my favorite stock to pick on, GE. I would never put money into it. Let's take a look at its dividend because it is a dividend-paying stock. And for those of you who don't know, dividend-paying stocks are usually more mature companies. GE is very mature. It's been around for a long time, but we look at the graph, I would never buy into it. I mean, it's been in a bear market for the past 5 years. 10 years, it's lower than what it was 10 years ago. So it's a declining stock. I would even consider it a dying company. poor management, but we're not going to get into too much of that. But you could see back in 2017, it looks like that's where its high was at around $30, and it's just been going down like crazy. If we jump over to its dividends, we're going to look at its dividend yield. You could see right here, 2017, before its decline, right? Its yield started going up because as the price falls, its yield has to go up just to maintain that constant payout. If you are expected to get, $5 a year from a stock, and if the price is falling, but it's a very big mature company, that company is going to feel a lot of pressure. It's going to want to continue to keep that up and continue to keep giving you that $5 a year. But as you can see in this chart, eventually they can't sustain that, and this is what happened to GE with its dividends. It plummeted down to it's giving 0.35% of a $5 stock now. So that's a major thing that you need to look at. When you have a huge spike like this, right? Back in 2018, it was 6.83%. That's showing a big problem, and here's what happened. It plummeted. So don't chase after those stocks that, their percentages are really high. They're in that 5, 6, 7% range. That's usually not a good sign, and it's just not sustainable. Because you also got to remember, for every dollar that gets paid to you as the investor in dividends, that's a dollar that's not going back into the company for reinvesting. But let's get into what a good dividend yield is. We know that 5, 6, 7, 8% is too high. So where's that sweet spot? So you can look it up, and the magic number is usually 4%. People aim for 4%. If you Google it, it'll tell you around 4 to 6%. Once you get above that 6%, you're getting into some bad waters. But me personally, I even like to go lower. I like that 2, 3%. That's because I want them to take that money and reinvest it back into their business. I have a very long horizon. I have 30 plus years of investing. If you're someone who's older, maybe you only have 10 or 20 years, then yeah, maybe you want those higher yields. You want that 4 or 5%. But if you're young like me, you're in your 20s, you're in your 30s, don't be scared to go for that 2% or 1% or even less than 1%. Perfect example is NVIDIA. Very low dividend yield, great company. It's made me a lot of money in a very short period of time. And I think it'll continue to grow. But let me give you an example of a model dividend stock that is 3M. Its ticker symbol is MMM. Very clever there. You could see their dividend yield right now is hovering around that 4%. Its average 4-year dividend yield is 2.77%. But that is because if we just go to the summary really quick, we go back, say 5 years, you could see the stock, right, for a decent amount of time has been growing until about 2018. It is down right now, but you got to think everything going on in 2020, it is affecting a lot of companies. But we go back to the dividends, it is still paying its dividends. If we go to the yield, we can see that. We could scroll back. Now this is really cool. Look at this. If we scroll back, you could see it is hovering between that 2 and 4%. It's not really breaking that. There's a very strong history for its dividends. Here's the past 10 years. 2% down to 1%. It's 4% right now. Stock is taking a bit of a hit in 2020, but they make masks. So I would say the stock is probably going to go back up. It's probably having better sales. A lot more people are going to be more conscious about, masks and other stuff that 3M sells. So I think it has a pretty good future. It's a stable company. But dividend yield is just one piece to the puzzle. There are 2 other metrics or fundamentals that are really important to look at, and this is where stuff starts to get very interesting. And those 2 things are yield on cost and payout ratio. Those are very important when you're considering dividend stocks And if you want to check that out, you could see the next video wherever that will be in this end screen. Click on that and we'll continue this conversation. If you like this video, if it brought value to you, give me that thumbs up. Hit subscribe if you haven't already. All right, I'll see you in the next one.